Okay, welcome everybody to episode 83. Scrambling around here trying to remember to start this thing. Unfortunately, I was doing some videoing earlier and my camera battery was in the charger and it kind of freaked me out. But here we are. I made it. Everything's fine. 2 minutes late. I've never actually been late to one, so hopefully everybody considers this not overly late. Maybe doesn't count against my record, but yes. Okay, so here we are. What I wanted to do is just very quickly remind people that, as I mentioned, I'm actually kind of back in the laboratory making a bunch of videos, and they're going to be pretty heavy focus on volatility videos. So just give you a little brief glimpse at what we've been doing. A lot of these are very volatility specific. So, I basically took a while off and then we've come back. The last 8 videos, I'm trying to get more direction and focus. And so this is our course library at VTS. It's not only just trade signals, of course, there's a lot of education as well. And a lot of these courses are finished, a few of them, but there's a couple of them that we have just started. So just to give you a little brief view here. This one here, the volatility landscape, that's what these 2 videos are about. So you definitely want to check those out because this course is going to have a lot of follow-up videos talking about all the volatility metrics that I use. Apologies, it's actually this one, volatility dashboard. This one, the volatility landscape, yes, that's these 2. I'm going to be doing individual videos on VXX, UVXY, SVol, all of the volatility ETPs. So you definitely want to follow along because we're basically going to have more focus on building just these 2 courses. So, I don't know how long you've been following me for, but I've had a little bit of an issue in the past where I have ideas and I can go off on all these tangents, and sometimes it's a little bit confusing for people. So I've decided to just set my course, have a couple of courses that I'm just going to build out 20 videos in each one of them and try to have a little bit more direction. So now would be a good time to follow. Of course, hit the subscribe button. Something like, you're looking at the YouTube analytics, 60% or something of the people that watch my videos are not subscribed. So make sure you do hit that subscribe button for me. And let's get right into this. So the style that we've been doing lately, I've just been down to one segment. So I'm just going to present one thing and then we'll get right into the Q&A. So I can see there's actually quite a few questions already popping up. You can go ahead and ask your question. And let's click off this noise cancellation. The sound is probably already terrible. For that, I always forget to click that little button. Noise cancellation. Mental note, always click that button. All right, anyway, let's get started. Okay, so what I wanted to talk about for today's segment, this shouldn't take too long, but one of the issues that people will start to struggle with as we go forward, right? Of course, it's been a very long bull market, so a lot of people are not aware of this. But I did want to point out the fact that the S&P 500 not only doesn't always go up, but when it goes down, I think most people would be surprised to see how long it actually stays down for. I think people are sort of more used to the 2020, it was down for a little bit, few months. COVID, it was down pretty substantially for, down 35% or so. But the government came in and rescued everything. And within a couple of months, it was at an all-time high again. This is not normal. But unfortunately, most investors' time horizon is pretty short. So they're not actually aware of the true history of the stock market. So I wanted to just point a few things out in this respect. So I'm going to throw in a couple of clips, maybe try to make it a little more entertaining. But you'll get the point. Cancellation always. Don't listen to any of these investors out there telling you to buy and hold the stock market. They are leading you down a path to severe investing punishment. Did you know that during the financial crisis, the S&P 500 crashed 55%? And on an inflation-adjusted basis, it took 6 years to get back to break even. And did you know that if we include the dot-com bust before that, the markets crashed and took 17 years to get back to break even? A financial crisis like those ones is definitely going to happen again. It's just a matter of time. These investors telling you that buy and hold is a good plan have no experience of what it's actually going to feel like in real time to lose 50% of your net worth and take over a decade to get it back. Our VTS community uses tactical investing with volatility targeting. We know we can't afford to suffer drawdowns that large, and we definitely can't waste that much of our investing time horizon. You can learn a much better way to invest in our VTS community. Okay, so I wanted to just review that really quickly because people actually are not really aware that this is happening. Because, of course, most people have only been investing for, say, 5 or 10 years. Very few people were investing back before that. So they don't even know the real history here. But like that little clip said, if you look at this, and what we're essentially looking at is the real inflation-adjusted performance of the main 3 indexes. So the Dow, the S&P, and the NASDAQ. We'll focus on the purple, which is the real S&P 500. Now, just a side note, this is, of course, using the official government numbers on inflation. Now, I have a video coming out in the future, probably in about 3 weeks or so. Like I said, I'm going to try to stick to a schedule, so I think that one is scheduled. It's already done, but I think it's scheduled maybe a month from now. But the punchline from that is that the real inflation value is a lot higher than the government is saying it is. But this is just using the official numbers. You can see that a person who invested at the beginning of the dot-com bust, they took actually 17 years to break even. This process is something that very few people are aware of. And you can see here during the COVID crash, it was only a couple percent away there. And over here, it was only 35% away at the bottom of the 2022. But again, if let's say inflation is overstated by say 1 to 2% a year, that's 22 years later. That means that right here, inflation adjusted in the real world, when we're actually spending on housing and food and energy and all the things that actually matter, it was actually below as well. So you could make a case that it took over 22 years to get over the high water mark. That is a very long time. But this is not just a recent phenomenon. This is actually how the stock market works. It goes through short periods of exceptional performance, and then it can go through really long periods of just clawing back from previous drawdowns. So you can see, I mean, of course, we don't really care what happened in 1908. That doesn't really affect our markets. But you can see it's happened several periods in the past where, you know, if you get caught on the wrong side of one of these things and you retire at the wrong time, you could be in serious trouble. You know, after the Great Depression, after 1929, it took 27 years to break even. It took until 1955 to break even. Here, inflation adjusted, again, using government crap bullshit numbers, it still took 25 years up until the raging bull market in the 1990s. And then, of course, we're in a raging bull market now for the last 10 years. But again, if we really look at it, inflation adjusted, it's not really a raging bull market for the last 25 years, is it? It's only a bull market when the vast majority of investors just started their investing journey. So there's a lot of people out there that think this is an easy game to play, but trust me, it is not. There's going to be a lot of people who currently are confusing just dumb luck in a bull market with their actual trading skill. But again, this gets back to the retirement issue where depending on when you retire, this is going to matter a lot. And this is what's important and why people just can't buy and hold. So I'm sure you've heard of the 4% rule. This is essentially where they say that, you know, as long as you're making a decent investment return and you're outpacing inflation with your investments, if you pull out 4%, I think 3 or 4 is reasonable, then you know, you should be outpacing this value enough that when you're pulling out money from your account, you're not actually losing a whole lot. So if you just would imagine a standard, let's say you're making 10% a year and inflation is 4, right? I think it's a little bit higher in the real world, but let's say it's 4. There's 6% there. If you're pulling out 4%, you're actually still outpacing it and your principal is not going to be drawing down. Now, there's a couple other people that, of course, have mentioned higher withdrawal rates just for pure comedy and educational purposes. We can talk about one of those such. Ramsey is dead wrong number 2. He's apparently never heard of sequence risk.
I mean, if you're making 12 in good mutual funds and the S&P is average 11.8, and if inflation for the last 80 years is average 4%, if you make 12 and you need to leave 4% in there for inflation raises, that leaves you 8. So I'm perfectly comfortable drawing 8.
What is this guy talking about? Simply put, sequence risk is the concept that the timing of investment return and withdrawals can significantly alter the investor's end result. Two investors getting the same rate of return but starting at two different points can end up in completely different places. When you start withdrawing money in retirement, if the stock market cooperates and you get 5 to 10 good years to start your sequence, then yeah, you'll probably be fine. But if there's a few down periods early on, that can be catastrophic to the value. It's a double hit of a declining portfolio value while you're still pulling money out of it. We could have an entire generation of Dave Ramsey followers that run their portfolio right into the ground because of sequence risk. Good old Dave Ramsey. He's actually fine for like basic budget stuff, in his folksy kind of way. He's helping people, don't buy brand new cars, all that stuff. It's fine. But I would definitely steer well clear of the guy if it's talking about investment stuff. He gets quite a bit wrong in that respect. And of course, one of the things he gets wrong in that clip is sequence risk, which I'm going to talk about in a second, but he says that the S&P has made 12%. He's actually confusing arithmetic and geometric return. It has not made 12%. Arithmetic is just when you add up all the years and then you divide by how many years. That's not how investing works. It's actually geometric, where it's compounding on itself, and the geometric compounded return is closer to 9%. So again, Dave Ramsey's math of 12 minus 4 is 8. It's actually 9 minus 4, and then that 4% number, of course, for inflation is also quite dubious. So I think Dave Ramsey is quite misinformed on investing. But again, for budget stuff, go for it. But here's an example of what we're talking about. So the blue line scenario, this is where every year the investments are making the same amount of money. Let's say it's making 8% a year, inflation's 4%, and you're pulling out your 4% for your 4% rule. This would mean that your investments are basically flatlined. You're good to go, right? You're not drawing on your principal. Scenario 2 is the orange line. If you get 5 good years when you retire, let's say you retire in 2014, 2015, you're getting 5 to 7 good years of investment return after that. You're going to be fine because your investments are outpacing that. But if you happen to retire at the wrong time, this can be absolutely catastrophic. So if you would imagine what were to happen, again, let's just choose a basic example. The S&P 500 was down 56% in the financial crisis, but a 60-40 balanced index fund like the Vanguard VBinks, it was down 38. So let's just say 40%. So let's say you're down 40%. Well, that is going to take your portfolio. Let's say you got it all the way up to $1 million. You were feeling pretty good about yourself. It's time to retire. I got $1 million. It's going to last me 20 years. And you get some bad results early on. So now your million is down to 600,000. But there's also inflation, right? 4% a year for a couple of years. Let's say that's 8. And then you're also pulling 4% out for a couple of years. So that's another 8. You're actually down 56%, right? In a balanced index fund, because inflation and your withdrawals. So your $1 million portfolio that was supposed to last 20 years, after 2 years, it's already down to 400,000 or 500,000. Now that money has to last you the next 20 years. You'd very quickly be scrambling around trying to get a part-time job. That's what's going to happen, because sequence risk is, again, what is happening quite often. This is, again, the point of doing stuff like this. People don't actually know this, that sequence risk is one of the reasons why so many people get to retirement and then they really don't have as much money as they thought because, of course, inflation's higher than they thought it was. Spending is always a little bit higher than you anticipated it was going to be. And then also, if you just get bad timing, you catch one of these periods where you're in a drawdown for 20 years, you could be withdrawing money from your account for 20 years straight and just clawing back to break even. You're basically going to lose all your money very quickly, and hopefully you have children that have jobs that can take care of you, because it's going to be a huge problem. So this is a retirement crisis. There's many reasons why there's a retirement crisis. That is one of them. But of course, just a short little spiel on how we deal with this. I am a tactical investor. We are not buy and hold. We have to actually sidestep those major drawdowns. We can't just hold on to this thing and just say, well, that was 10 years ago, 15 years ago. That's not going to happen again. I think it is going to happen again. And this has been a 14-year bull market. I wouldn't be surprised if it happens fairly soon, within a few years, right? I'm not calling doom and gloom or anything here, but it's time. The market is not nearly as healthy as people maybe think it is. But again, we're not day traders. It's not necessary to be churning trades. These are all the strategies and all the trade frequency. And you can see month to month, There's only 2 trades per month. All we're really doing is trying to sidestep a few of the major periods that, if they progress and go from 5 to 10% correction down to 20, 30, or 50 at some point, that's when tactical investing is really going to shine. So for our tactical volatility strategy, most of it we are in short volatility, because 60, 70% of the time, there's no reason why you wouldn't be aggressive in the market. But we have to be willing to cycle out into safety, because sometimes the market does go down. Shocking, I know, it's been a long bull market, but it does happen. And then occasionally we do also go long volatility to try to capitalize on the crisis. Defensive rotations, kind of the same thing. There's 4 sections here, but mainly it's the QLD, which is 2 times NASDAQ, but we do cycle to utilities and we do move into cash. This one won't go long vol, but it is in cash. And then strategic tail risk, kind of the same concept, different thresholds, different volatility metrics. But again, the SPY is the driver of most of the performance. But then we can cycle out into real estate, and this one also will do long volatility. But again, we're not talking about day trading here. It's just 2 to 3 trades per month on average, just to sidestep those periods. So as an example, I can just point out our QLD, for example, we entered on November 1st, which was right there. We entered the position and we held this position without selling the entire period until the 16th of April, which is right there. We held it from that day to this day uninterrupted. We made all that profit, and then we exited because the volatility metrics were climbing and elevating, and we have to get out to safety. So we got out there. We got back in a few days ago, and I think we're up a little bit on that trade. As far as the SVXY, this one, again, you have to be really careful when you're shorting volatility, because it can actually go down pretty violently. So again, we entered all the way back here. There was a couple of days we exited, I think for 1 day there and 2 days here, but we exited on April 8th, which is right there. So that's where we got our safety signal, and we moved into gold. And we've been in gold until today, right? So this whole period, basically flat. No, you know, we avoided this and then we missed out on this. But the point of tactical investing, like I said, this is only a 10% drawdown. Short volatility will have a 70, 80, 90% drawdown at some point. It's happened multiple times in the past, and it will again. So, of course, we have to exit out. We're out here. If the market totally collapses and it goes down eventually over the next 6 months, it goes down, 60, 70%, well, we're going to be fine. That is the point of tactical investing. It's not churning. It's just very slight adjustments. Couple of trades per month, that's all you really need. But if you're willing to actually cycle through and only hold the best position in the moment, that's when you can really start to get some performance. And you're not really going to notice it in the short term. This is not something you're going to notice that you're immediately getting this massive outperformance. It doesn't work that way. Tactical investing can be very boring and basically tracking, up or down with some whipsaw, tracking the market. The point is to avoid this stuff. That's the point. The point is tactical investing avoids all of this. And when you basically, like I always say, you try to participate in most of the upside and you try to avoid most of the downside. And when you do that over a 1 or 2 year period, you don't even notice it. You're like, wow, this isn't really working. You do that over a 20-year period, you can make 3 times as much money as you would have if you just buy and hold. That's tactical investing. Every couple of years, it pays off. Every 5 or 10 years, it pays off huge, and you make massive forward progress in your portfolio. That's how this works. It's really the only way to beat the market. All the day trading stuff, churning in and out, stock picking, I think Tesla's going to be better than this one, or that stuff doesn't really work. What does work is being willing to just sidestep to safety and just see, is this the big one? No? Okay, we're back in the market. That's basically what happened this time around. April 8th, we're out. We're back in already, right? No big deal. The market only went down 5%. It's fine. If it was down 20, we would have noticed it. We would have got a nice boost there. But turns out this time around, we didn't need it, and we're back in the market. That's tactical investing. It's not flashy. You can't notice it in the short term, but in the long term, it's infinitely better than these asset managers that are telling you to buy and hold. Of course, I've gone on many rants about the asset management world, but it's really frustrating when they're doing this because, of course, if the market crashes 50%, You lose 50% of your money as a client. You lost 4% a year from inflation, and you're pulling out 4% a year. Your money's disappearing super fast, and you still have to pay them 1% of your assets every year. So they still get to go to their summer home in the Hamptons, but you've lost 70% of your money. That's kind of the game they're playing there, where if it works and they're tracking the market in a bull market, great. When it collapses in a bear market, what do they tell you to do? Just hold on. Isn't that interesting? That the same strategy in a bull market and bear market, same result. If it's a bull market, they're doing a good job. They get their 1%. If it's a bear market, just hang on. Don't sell. It's fine. I still get my 1%. That's a great job, right? I mean, that's kind of the dream job. And maybe kind of makes me question what I'm doing here. But, you know, I just don't believe in that kind of thing. And I think as this bull market starts to wind down, I think it's going to be more apparent to people that basically it's just been recency bias. There's a lot of people who, if you just started investing in 2014, a lot of this stuff is not going to make sense to you until you actually see your portfolio get cut in half. And then you're going to be like, oh, yeah, that guy that was ranting on that live stream, turned out he was right. I wish I listened to him. So maybe listen to me now. But there we go. There's the segment. Let's get into the Q&A. There's a lot of questions here. I don't want to be here too long, but I do like to answer everything. So hopefully there's some interesting ones. Maybe try to get me canceled. Those are always fun. I've had to dance around a few subjects in the past, but here we go. All right. First question. Total Dentistry. Read an article that said covered call ETFs were keeping VIX artificially low. Thoughts? Well, first of all, VIX is something that if you write about the VIX, you will get 10 times the traffic that you get on any other subject, pretty much. There's a couple of those hot button subjects. So write an article about Tesla, it's going to get eyeballs for sure, even if it's completely unwarranted, unfounded. You know, some of the other ones, VIX, of course, stuff like that, zero DTE options. There's a couple of areas where there's just a million articles written. Now, I don't personally believe, there's tons of articles out there about the VIX suppression and all these things. I don't think it's helpful because there's no evidence. We just know that, you know, we can't find any causation. We can basically only identify correlations. It's not really overly helpful. So what I tend to just do is default to if the VIX is being artificially low, if it's being manipulated, if it's, you know, whatever's happening, we still have to trade this market. So I don't actually have to know why it's happening. I'm just tracking the volatility metrics and then moving into the right positions. So I don't really have to find the causality of this. We just know that in the last couple of years, the VIX has not been responding quite as much as it, say, used to, right? 2022, S&P 500 was down quite a bit at the low, and the VIX just didn't respond. But I don't think it's overly helpful. It's the zero DTE stuff, it's the VIX manipulation, it's the big hedge funds, it's the covered call ETFs. I'm sure it's a little bit of all of it, but got to trade the market in front of us. I tend to not waste any time trying to complain about things like that. Not that you're complaining, you're not, but do you use the gamma flip line? No. I'll answer this one quickly. No. As part of your overall vol equation, below the line dealers buy into sell into selling, above the line dealers buy dips and sell rips. Yeah, you're new here, I'm sure. I've ranted on the gamma stuff and the dealer positioning a lot. And the bottom line is, I understand the theory. It does sound intriguing, right? These people who sell that type of service, there's websites that'll give you these flip points and tell you the dealer positioning and the gamma flows and the Vanna flows. Okay, we understand the theory. I've actually never seen any evidence of it working, because just because you're doing that, there's a massive swath of the investment capital out there that's not following that. That's just a small segment of the market, right? I mean, even on the ETF, ETN level, you're talking about you're skipping out quite a bit already. So it's one of those things that I think in theory sounds pretty cool. I've never seen it work in practice. And I'm always open to be proven wrong. So please, if you've got links to somebody who has an actual track record, I'd love to see it. I have yet to. That's the bottom line. I have yet to see anybody actually prove it. But what they will always do is say, oh, just go check the website and here's what it means. Here's the line and here's what the dealers are going to do. Great. I get it. I understand the whole theory. Show me with numbers. If this, then that. Prove it to me. Never seen one. So if you're going to be the first one to prove it, I'd love to see it. Send me a link and I will definitely objectively take a look at it. But no, I don't use that. All right, this is a good one. This sounds interesting. I always like to see the volatility ETF tickers in the question. Can you give some examples of what kind of results or strategies that use VIXM and VXZ in high vol regime could have had using VXX or even UVIX instead during past crashes like 2020 or 2008? I actually can show you some stuff there. And I can do a little bit of a plug on my service as well. So remember I mentioned that we have a library of courses. One of the courses is the Tactical Volatility course. Let's go into this one and let's find you what you're asking about. So one of them that looks intriguing is that one. Another one that I remember writing about something about market crashes. Largest market crashes. So let's do this one first. So what this one is showing sounds like the first part of your question there. How would we have done? Because I use the VXZ and the VIXM. These are midterm futures. So if you're talking about the VIX term structure, I use the ETFs that play over here in the 4th to 7th month range because they move slower and they're far less punishing when you're wrong. Of course, what we know about the long volatility trade, it is extremely difficult to get the timing right. So you do actually get punished quite a bit for being wrong, right? You enter long vol, the market's crashing, you think you're going to make a bunch of money, and then the Fed comes out and says some great piece of news, or the government says we're going to stimulate the economy, and the market bounces 4% in a day, long vol gets crushed, and you're sitting there thinking, oh, my dreams are shattered. That tends to happen when you're trying to go long volatility. So I like the slower moving products because they punish you less. But if you want to see a comparison between the VXZ and the VXX, I can just sub them out. So of course the VXX is a stronger product because it's using the front 2-month VIX futures. But what ends up happening, yes, you could make a case that the performance is slightly better. You can see on a terminal basis, the performance is a little bit better, but the drawdown is a lot worse, right? So we're talking about my strategy, and this is only on 2.59% of trading days. So these numbers might not sound impressive, but then you think we're making, nearly 9% annual return boost just on less than 3% of trading days. So this does not include all the short vol, long vol stuff. This is quite literally just this position there. Of course, when we include all of this, the performance gets into about the 30% range, but 8.67 with a 15% drawdown compared to 12 better with a 36% drawdown. In your question, you asked about the UVIX. It would be similar. It would be like a 14, 15% annual return with a 60 or 70% drawdown. It's a complete non-starter, right? The sum of it, the moral of this is that the slower moving products that are using the M4 to M7, while they're not quite as impressive in a market crash, they still move an insane amount. But they're far better when you get one of those whipsaws where the market just screams the other way. The VXX, the UVXY, and the UVIX, they get punished an insane amount because it's front month. These ones are the first ones to move. These ones take a few days. They take a little bit longer. So if you get caught in one of those really bad days, if you're holding one of these products, these ones don't drop nearly as fast as these ones do. This one, especially the front month, it is an insane crash very quickly. You want to avoid that. So I don't use those. Your second question, I also showed our performance, and some of this is a back test because I launched officially live with subscribers in 2012. So this first one is a back test. Just full disclosure, this didn't actually happen. I launched in 2012, but I wanted to include it because that's the one that everybody asks about. And I believe, yes, you asked about it as well. So this is the results. Basically, this is the back test of my strategy before I launched in 2012. You can see that the strategy would have been up 77% instead of the S&P being down 55%. So, of course, this is what I was talking about, that tactical investing It's not overly impressive year to year, but every now and then you get an insane boost. And what we need to get the boost is we need the market to crash. You're not going to notice the benefits of tactical investing if the market is just going higher all the time. We're in the S&P 500, we're in the NASDAQ, we're in short vol, we're making money as well, but you don't get that massive outperformance. This only happens with tactical investing over longer periods of time. So again, here we go in COVID pandemic, up 100%, stocks were down 34. What is this one? Oh, this is 2022. You can see here in one clear chart why 2022 was such a frustrating year for so many investors, including myself. Volatility just didn't spike. So we didn't get the signals to move out into safety very efficiently. And as a result, we didn't outperform the stock market in 2022. It was just one of those years where everything was down. That was terrible. What is this? 2018, Q4 2018. Another good period. Actually, remember, we made about 3%. It says 1.98. I think we made 3. This is a back test. China, hard landing scare. You can see when it falls off a cliff, that's where the outperformance happens. You get these pretty significant bumps of performance. But again, it doesn't happen all the time. But every now and then it does. So to answer your question, I do not like using fast-moving products with long volatility. Absolutely not. Because, again, it's not the lack of performance. It's the punishment, and you will be punished. If you're in the habit of buying long volatility, you're going to get the timing wrong sometimes. It's part of the game. Long vol is a very, very tough trade. So I would always recommend people use the midterm products. All right. Does VIX versus SPX covariance or correlation figure into your strategies? Yeah, it does. Hard to give you a percentage because I use what is called the volatility barometer. I'm sure you've at some point come across this. This is my daily email today. You see we made a couple of trades. We're not day traders, but there are days where we do actually do a couple of trades. But the volatility barometer is a comprehensive sort of, at this moment, there's 13 metrics being included in basically my own creation of an index for volatility. And yes, the VIX to SPX correlation is in here in some capacity. If I had to put a ballpark on it, though, probably 3-4%. I mean, it's not major, but yes. Stuff like that. I mean, of course, the VIX futures weigh heavily. Of course, the cash VIX term structure, the volatility risk premium, things like this weigh a little bit heavier. But then there's other things VIX related. I don't really love the VIX, to be honest, but of course, it's part of the landscape, so some of it's in there. What else have we got? Nothing embarrassing yet. Does pair shorting leveraged ETFs with daily rebalancing still work? It never did work. Are there any risks? For example, SPXL and SPXS. So every trader who's ever been doing this for an extended period of time at some point starts dabbling in this pairs trading game, right? Whether it's volatility pairs, like I'm going to go long. A friend of mine is actually testing something right now on Twitter. Long 2 times the SVXY, which is basically a 0.5 product. So 2 times is a 1 times SVXY. And then pairing that against either long VXX or short SVIX, right? So long 1 times, short 1 times, presumably they're both going to lose a little bit in that volatility drag, right? And that is true. But what you're not factoring in is trade fees and borrow fees, right? So that's obviously a huge problem. The other problem is these types of pairs that you're talking about, they have great performance sometimes, but the timing matters so much. And of course, we can't really time the market in that capacity. But if you start your pairs trading cycle, like after a crash, you would be more successful doing it. But if you start it during a more stable market period, you're going to realize that the one that you're actually, going to be punishing you, it's going to be punishing you a lot. So timing matters a lot, and always factor fees and borrow fees if you're doing like a long short pair. If you're doing just short both of them, some of these things can be anywhere from say 6 or 7% borrow fees up as high as 20 to 30. Like if you're doing a pairs trade on something like the UVIX can easily get 25, 30% borrow fees. Obviously, it's going to crush any alpha that the pair provides. So I would say no. I would say that the apparent alpha when you're looking at it on a chart is quickly eroded by the practical sense of trading it. I don't think there's anything there. I've gone down that rabbit hole as well, and sometimes there's a little bit of alpha, but it's never going to be impressive enough. It's not like you're going to get a pairs trade where you're making 15% a year. I would rather focus all of my capital on something that can make 15% a year, rather than something that, if you get the timing right, you might squeeze out 5% here or there. Just not worth tying down capital for something like that. Okay, is that first question? What's the sweet spot? How many days out delta strategy vertical versus broken wing butterfly using volatility, let's say short UVXY? So vertical, it depends. Verticals can be used, like it's one of the most versatile option structures there are. So sometimes my vertical trades are over 100 days out. Sometimes they're very short term. Like just as a quick example, what can I show you here? So if we're talking about our tactical volatility strategy, let's say, for example, that every time I get the signal to be short vol, actually I can explain it probably better here. Every time I get a signal to be short volatility, if I was to replace this with vertical spreads, I would probably do extremely short term. So if I got the green light here, I would be doing short-term, long put verticals on, say, VXX or UVXY. I do prefer long put verticals compared to short call verticals. They're mathematically identical, but short call verticals have the in-the-money strike a little bit closer to the money. So, option assignment and whatnot. I prefer the long put options. But you would do the very short term. If you get a signal like this, you could also, because fading volatility is a legitimately good strategy, but because sometimes it can hang out in that mid-range for a little while, for this signal, you'd probably want to do the monthly cycles, right? That would be fine. Anytime it flashes gold, you could do a longer term, 1 month, maybe 5-6 weeks, long put vertical on the VXX. And then if you get something like this, of course, you've got to give it a little time, but for this one, maybe you could go 3 months out and you could do a long put vertical again on the UVXY, give it 3-4 months, and that would be your signal. So when you're getting these ones, you're just churning really short-term trades. When you're doing this one, give it a little more time. When you're doing this one, of course, give it a lot more time. With broken wing butterflies, I tend to always do roughly 11 to 22 days. So what do you think? Verticals, I can't answer what is the best sweet spot because, like I said, time matters a lot with the volatility trade. We know that eventually everything's going down, right? But you just don't want to run out of time. Being early, getting the timing wrong, that's the same thing as getting the trade wrong, right? Even if you're eventually right, UVXY does go down long term. It's not enough to just know that it goes down, of course. Everybody and their dog knows it goes down. What we need to do is identify some actual alpha in the timing metrics and understand the timing of that thing. So, but I can answer the second one. Broken wing butterflies, I personally like 11 to 22 days. Basically 2 weeks, but the reason I say 11 is sometimes, say, on the Friday you didn't do a trade, and then you come back the following Monday and you just get a quick trade in. That would be 11 trading days. And then sometimes instead of doing it the following Tuesday, maybe you want to do it the previous Thursday or Friday. So that's why instead of saying 16, it's actually 22. But basically 2 weeks. That's my answer there. Hopefully somewhere in there was an answer. All right, I joined VTS. I'm a bit confused about a small contradiction. Uh-oh, did I contradict myself? I run a pretty tight ship. Hopefully you're wrong. It seems the past you divided your portfolio strategy into 5 categories and now is 4. Okay. Breathe a sigh of relief. I didn't contradict myself. I just didn't explain it clearly. So yes, you are correct. Last year, we had 5 strategies at 20% each. So one of them was called volatility trend. By the way, the volatility trend course, come on, where are you? The volatility trend course was not removed from the library. I hate when my live stream stuff is blocking my vision. The course is still there. So anybody who wants to join VTS, there's a free trial on my website. You can check out this full course and it will teach you how to trade are broken wing butterflies on the UVXY, right? There's a full trade. How many lessons are there? 12. I'll probably add several others here. But yeah, this will get you going. And this is still included. But to answer your specific question, at the end of last year, I did remove that 20% for the butterflies. It was, I actually even wrote an article. So I usually don't do this. I usually on the fly, I will still answer the question. But I think in this case, an article will explain it better. I wrote one talking about how the strategy, God, have I uploaded that many already? Our volatility trend strategy is taking a break in 2024. Read this article, and it basically explains why we removed it, but it will be back, right? It's a great strategy. I personally like it a lot, but it was extremely confusing for a lot of other people because I didn't have the full course built out. I didn't have the videos done. And so it bogs me down quite a bit with email answers and, several hours of answering the same question over and over again. So I just have to do a better job explaining stuff. Strategy itself is fine. And that's the difference. So last year we had 5 strategies at 20%, and this year we are currently at 4 strategies at 25%. But that will change over time. When I launched in 2012, I had 3 strategies. I had the Iron Condor strategy. I had basically what was the defensive rotation, but at that time it was called the tactical balanced, and it was using different tickers, but same volatility metrics, and with the tactical volatility. So we had those 3, and it was, when I launched, I think it was 50, 30, 20. 50, 25, 25 maybe, but 50, 30, 20. It changes. I just have to, as I say, I got to put my starting lineup out there every year at what I think is going to perform the best in my portfolio for that year. And I think this year those 4 are pretty good. So I will come back. Volatility trend will be back for sure. Does your theory on shorting inverse volatility work in other inverse ETFs like SQQ and TZA? No, not the same way. If you're talking about using volatility metrics, the way that I do it is the volatility metrics have to be paired with the right underlying strategy. If you try to use volatility metrics in the wrong way and apply that to the stock market, it's not going to work. For example, I think I even did an article, but it would take me a while to find it. I compared using the VIX futures metrics to go short the UVXY 60% of the time, and then 40% of the time in cash, and then instead of SVXY to do the SPY, the S&P 500, and it doesn't work nearly as well. But there are other volatility metrics that work quite well with stock market stuff and not so well with volatility stuff. So this is just something sort of, inner circle type stuff, I suppose, where you just have to know how to apply it to which strategy. But our tactical volatility strategy uses a different set of volatility metrics than our defensive rotation does, because you can see this one is not using volatility ETFs. So if I'm using very heavily VIX futures related metrics to trade this strategy, the results are not nearly as good. And if I'm using sort of volatility risk premium and S&P 500 historical realized vol correlations between the VIX and the S&P 500, like the previous question answered, that's going to be much more appropriate to be trading stocks, utilities, bonds than it would be trading volatility products. So I have to be very careful on my end that I know what I'm doing, and I'm making sure that within all of my volatility metrics, not all of these work for the same underlying tickers. Some of them are fantastic for volatility trading. Other ones are really good for stock market. And you kind of have to know which one is which, unfortunately. I would be giving you away proprietary information if I told you which ones go with which. But it's a very good question that, yes, you have to be very careful, because sometimes volatility metrics just don't apply to other markets, right? You're not going to have a whole lot of success trading gold with volatility metrics, right? Or some of them, VIX futures, roll yield, stuff like that. It's not great. So there's an article floating around there somewhere talking about that. All right, Alberto. Also another question, and I can see 4 more questions here, so let's get through these. Having completed your butterfly lessons, you mentioned that the way to make butterflies work when shorting volatility is to create them in times where volatility is already close to its lower level. And just create the butterfly aiming for a range where the UVXY will be within its natural decay. With the VIX as low as it is now, can we expect butterflies to be traded in VTS soon? And then you went on to say, you're loving the content. Okay. Has been bringing it for the last month. Yeah, thank you for that. Thank you for noticing. I feel too, not to boost up my own work too much, but I do feel like the last few videos, like the last 8, are much more in line with the direction I want to go. Like I said, I do have a tendency to bounce around all over the place and gets a little bit confusing, but I've got the direction now: volatility metrics, volatility ETFs, explaining our portfolio. There's 3 courses. We're going to just fire on those 3 and keep everything consistent. Yes, essentially what you're talking about is, oh, I didn't do screen share. I almost misfired there. Still kind of a rookie at this. Let's do UVXY. That'll make some sense. There's a butterfly that I'm sort of considering there. Essentially what he's talking about, this is what a broken wing butterfly on the UVXY would look like right now. Like I said, I'm kind of considering this one. Market was down quite a bit today, or up, so the UVXY is down quite a bit. It was actually over here before. But broken wing butterflies are awesome because I can transfer all of the risk on the high side and throw it on the low side. So now it does not matter how high volatility spikes, I'll still make money with this trade. And if what happens actually does happen, that if it started, say, around here where I was planning out my trade, it's just going to decay slowly into this nice big range. And I actually, for the VTS community, I actually calculate every day and I show, based on all of the volatility metrics, where these products are expected to be in 1 day, 5, 10, and 21 days out. So like I said, for my butterflies, I typically do 11 to 22 days. So we're talking about this range right here. We're expecting the UVXY, this was as of market open today. So the trade that I was planning out is already a little bit behind, but we're expecting it to be around, say, 29, 25. So I'm kind of expecting it to be somewhere here based on long-term decay factors, somewhere right there. So all I have to do is set up a trade that's, if that were to happen, it captures this point. And of course, it's a short volatility trade with no upside risk at all. That's pretty awesome, because what scares people the most about the short vol trade is what happens if the market spikes. Well, with a broken wing butterfly, the answer is nothing. You actually make money, make a little bit of money. Now, obviously, people are going to be looking, well, what happens if the UVXY goes all the way down to 28? Well, yes, that could happen, but you have to remember that we are holistic traders with an entire portfolio. So if that were to happen, I am in the S&P 500, I'm 2 times the NASDAQ, and I'm short volatility SVXY. So if I were to have a butterfly option that happened to go that far, that would surely mean the market has been crushing it, and the performance of these 3 strategies would far outweigh the loss of that butterfly. So it's really, this is why the strategy is so good paired with most people's portfolios, because the vast majority of people are already net long equities, net short volatility in some capacity. Almost nobody has a net short bias to the stock market. Nearly everybody carries a net long bias. So they don't need a short vol strategy with high risk on the spike side. We've already got plenty of that. Everybody in the world already has stuff that's going to do well in a bull market. Nobody needs more of that, but that's all that Twitter offers. That's all that these traders offer. More strategies that will do well in a bull market. Nobody needs that. I mean, they're dime a dozen everywhere. What that strategy does is it flips it around and it says, okay, we can still be short volatility, but I don't want to add anything to my portfolio. If the NASDAQ crashes, I don't want this trade to also crash, right? I want the opposite. I want to lose money if the rest of my portfolio makes a killing. That's better. So that's what I would say. What was your question? Did I answer it? Got off on a side tangent there. I love that strategy, the butterfly strategy. I don't quite know why it wasn't more popular, but surely because of me and just not explaining it clearly enough, because It is entirely unique. You will never see anybody else talk about it. Well, maybe they will now that I'm sharing it so publicly, but you'll never see it anywhere. But it is, in my opinion, that's what people need. We don't need more stuff that, oh, if volatility goes down further, here's a method to make money. Yeah, everybody knows how to make money when volatility goes down, right? We've seen the UVXY. We don't need more of that. That's no value added to the investment world. But flipping it around, kind of like my Wheel of Fun strategy, to tease another one that I do. I like to do clever things that work well within a portfolio, not as a standalone. And the Wheel of Fun, shorting VXX put options out of the money. And then if you get assigned, A, your portfolio was crushing it because volatility went down and you got assigned, that must have meant that your 2 times NASDAQ is already crushing it, must have meant that your short ball's already doing well. And then you take assignment, you sell a very aggressive covered call, and you make more money dumping those shares. So again, flipping the risk to the other side of the equation. For some reason, nobody thinks of this kind of thing. They always try to add more risk, and then if volatility spikes, just hang on for the ride and lose money. I've got plenty of stuff that's going to go down if the market crashes. What I need is stuff that's actually skewed the other way. And I would say the same thing. Everybody watching this live stream right now has more than enough allocations to things that are going to do well in a bull market and do poorly in a bear market. You don't need more of that. You're just doubling and tripling down on stuff you already have. So got to be an answer somewhere to those questions in there. I ranted for a while. If you're watching, don't forget to smash the like button and help the algorithm. Yes, thank you for the reminder. I always forget that. So what is it, 51 minutes in? Thank you for the reminder. Please, everybody, smash that like button. It's the number one thing that helps the videos, honestly. I wish it wasn't the case, but it is. Hello, right back at you. Do you hold any physical gold or silver as part of your strategies? No, I do not. There was a time in the past I had a little, I don't know, maybe when you start buying gold and silver, you get infatuated with just looking at it because it's just so cool. So I remember back maybe, God, this must have been 15 years ago. I had a little briefcase with gold and silver bars. I don't want to sound like it was millions of dollars. It was, I don't know, like 100 grand or something like that. But I had gold and silver bars, and it was just so cool. But what is it really? I mean, I've always kind of taken the attitude that, and I might be wrong, maybe if the zombie apocalypse happens, maybe I'm wrong, maybe gold will be useful. But I kind of think that not a whole lot will be useful at that point. If we get to a point in the world where gold is suddenly valuable, I think I've got a lot more to worry about than my briefcase of gold or silver, right? I would imagine I'd be fighting for my life at that point. Banks would have failed, international, relations would have crumbled. Boy, if gold makes a comeback and you actually need physical gold for something, we are in serious trouble as a society. So I kind of just ditched that. But it was cool. I admit I would pull it out and polish the gold bars every now and then. It was something I did. But no, not in my strategies. The only time we ever use anything related, where's my thing, is our safety position within the tactical volatility. We do use gold. It's actually a pretty solid safety position when the stock market is not doing well. I would never hold gold like buy and hold. That's awful, of course. And I would not hold gold during extreme crashes because it can actually sell off as well in a crisis. I don't know if you've noticed that if stocks really fall off a cliff, like if you go from here to there, people tend to also sell their gold, at least for a couple of weeks, and then gold could make a recovery. But if you look back in like the financial crisis, for example, gold also sold off early, and then it did quite well after that. That's the only use for gold for us. It's just basically a parking spot when I don't want to be in short ball. Has nothing to do with positive on gold. I'm very bearish on gold, to be honest. I think as an asset class, the rate of return is poor, as we know. That's just factually true. And like I said, I don't even want to imagine a world where gold bars and coins and silver coins actually became valuable again. That would be terrifying. Same as the Bitcoin crowd. If Bitcoin people think that during the zombie apocalypse, Bitcoin will be valuable, I think they've made a miscalculation there. No, I'm pretty sure you need functional internet and networks around the world, and of course, a counterparty that actually values the thing you're trying to trade. It would be terrifying barter system. Just defending your family as best you can. Don't want to think about that world. All right. Oh, I missed one. I'll come back to that. I see one said something about 2008. With the VXX long put substitute for SVXY, stock replacement, on VXX, can you sell puts against the long put with shorter date? You just layer in now, like a calendar, just to juice some more premium. You could, but what I always answer to these things is I like the way you're thinking, that if you've got a directional trade that is strong directional, right? If you're doing a stock replacement like we've got right now, I always give instructions for the ETF people. If you want to follow just the ETFs, it's much easier to do that, SVXY, just buy the ETFs. But also there are people, like for example, Europeans, they sometimes are not allowed to buy these ETFs. They're American and they need these KID documents and all these translations, and sometimes they're not actually allowed to hold these. So I give stock replacement as well. But your question, this is a strong directional trend following position, right? Long put options or long SVXY, very strong trend. So what you're noticing is, well, what if I sacrifice a little bit of the super strongest trend and I try to juice up that middle range? That's great, and it's totally valid for you to say that. But what I would say is, just make it two strategies, right? Don't try to do it in the same strategy with the same capital. It just gets messy because it's not always advantageous to do that. So for example, I have the tactical volatility and I have the volatility trend. Those butterflies, if you imagine how they overlay, like the one that I showed you, if you imagine this one, this is still a short vol trade. Because remember, I would actually have to adjust this down because of just the market's actually up pretty strongly now. So I would probably have to do something like this and just shift it down $1. And then I could open this one in good conscience, and this is actually a really good trade. Now the UVXY has to go all the way to 28 just to lose money, and all the way to 27. The rest of my portfolio would be crushing it if that were to happen. But you got to remember that we are in long SVXY. So if you overlay this, I'm super trend following, very strong here. So you're saying, what if we add some shorter dated calendars, or in this case, just add a butterfly? Yes, I do that as well. You're looking at it. The volatility trend is exactly that concept. The only thing I'm saying is I don't consider it the same strategy because it gets messy. There are a lot of times when I'm not trading those butterflies because I kind of have to be net long the market or that butterfly doesn't make sense, right? I need that offset because if that butterfly loses money, I need to make sure the rest of my portfolio has something in it that's good. So yeah, I would absolutely say if you wanted to do a longer dated, we do 100 plus days on the VXX stock replacement, 100 to 130 days. If you want to do some short-term calendars, some broken wing butterflies, you want to do some short-term vertical spreads, whatever you do, just take a small allocation and make it a separate strategy and just know how they are related to each other, right? There's actually a lesson. I haven't put it live yet, but there's a lesson in the volatility trend talking about the relationship between these two strategies and why they pair so well together. It's what you're saying. One of them is super strong trend. One of them is a mild strong trend. If you're willing to sacrifice a little bit of the slam dunk, you can actually make more money if you build up that middle range. So I definitely like the way you're thinking there. All right. 2008 felt like getting punched in the stomach each day. I can imagine. Especially if you were what most people were, net long the market, net short vol. I would be the opposite, right? My entire portfolio is based on the concept of volatility targeting. So once we get into those high 90 percentile ranges of volatility, I'm not allocated to the market anymore. So I would imagine and I'm not saying this to be like arrogant, I knew what I was doing. I didn't trade my strategies through 2008 either. I was pure option trader in 2008. I did not have the structure that I have now. This all started in 2012. So this is all hypothetical. I'm not pretending that I nailed it. Did pretty well in 2008, but not because of VTS stuff. But it would have felt pretty great for me because every day you wake up and it's still going down. That's what you want. If you're long volatility, your biggest fear is that the president's going to come out and say something, some great piece of news, or the Fed is going to say, oh, don't worry, we're never raising interest rates again, or, you know, we're going to lower interest rates to zero within the next 6 months. That's what you're scared of. The big news, massive volatility crush. So I would have just been waking up every day saying, you know, not that I'm cheering for people to lose money, because recessions are terrifying, but, you know, it's okay if Lehman crashes and Bear Stearns crashes and more stuff is bad. More money for us, right? So that's kind of the tactical volatility mindset that I always say. I do not cheer for recessions because real people in the real world get hurt badly. But that doesn't mean we can't quietly and politely make a lot of money during a recession, right? We don't have to brag about it. I'm not going to be all over Twitter, you know, talking about my big profits. Remember during COVID, I was in total safety right from day one, didn't lose any money. I was not all over Twitter saying, haha, look at you guys, you're losing 35%. I was not that guy. I'm going to be very quiet, making my money when the market is crashing. And the only way to do that is to be willing to actually rotate between positions, like I said. So volatility targeting for the win. Do you track vol backwardation percentiles in an effort to get long SVXY signal? Even if you don't trade that way, does that data exist in your database? Well, sure. I track everything to do with volatility, and it would include backwardation and contango. But I think you're flipping those, right? You said long SVXY, which would be short volatility. You would want to be short volatility in times of strong contango. And contango is actually not what you're looking for. What you'd actually want to be looking for is something much more similar that is, which spreadsheet am I looking at? I would say you'd want to be probably looking at something that is, like you've got your contango levels here, right? VIX futures. So this is backwardation, like you're saying. Of course, I track this stuff, M4 to M7 as well. I track that, but what you're really looking for is the roll yield, right? So if you really want to understand sort of the number one metric, you're probably looking at this video right here. It says, watch this VIX metric crush the S&P. Watch this video specifically, and you'll know what I'm talking about. But no, the contango backwardation, remember, that's not actually how the volatility ETFs work. That is just something that gets shared on Twitter a lot. But what's really happening is the relationship between the VIX futures and the VIX index and how many days to expiration there are. Contango is just a snapshot in time. Doesn't really mean a whole lot, right? You want to look at the roll yield. But yes, all of this is included. So the data does exist in my database. I've got a spreadsheet that crashes my computer. There's so much data there. So I think I got through all the questions. What's the time? 1:02. Perfect. All right. So everybody hit the like button, I assume. And if you didn't, hit it now. I will be back next week with another live stream. So forgive me for being a couple minutes late. Don't hold it against me. My record's still perfect, right? And have a good weekend.